In this video, we're going to record the payroll expense for the employees. So we're going to start off with their gross pay, and that's what we're going to allocate as salaries expense. So we're just going to do the journal entry. And the amount was 65950. And just a reminder that that's just this amount here, 65950. Now what we have to do is deduct the EI. So we have to collect EI on the employee's behalf, and then we'll have to remit that to Canada Revenue Agency. So I'm just going to put that into a payable account until that happens. So 1094.77. And that's that amount there. The same thing with income tax. So I have to deduct income tax from the employee's paycheck, and then I have to remit that to Canada Revenue Agency. So I'll put this into a payable account until I send in the money. And the same thing with CPP. So that's Canada Pension Plan. And I'll deduct that from the employee's paycheck and then remit that to Canada Revenue Agency. So when the employee first started with our company, we would have had them sign a TD1 form, and that will tell us how much income tax to take off, and we'll also deduct the EI and the CPP. And we keep deducting the CPP and the EI until we hit a max amount. So there's a max amount that once the employee has paid into it, we don't have to deduct it anymore. Now, we also have other source deductions that we'll take off. So medical insurance payable. So this company probably has a plan where they offer benefits to their employees for medical. So it could be medical, dental, life insurance, short-term disability, long-term disability, extended health. And so we would deduct this from their paycheck after taxes and then send that off to our benefits provider. So the employee would have to opt in on that, so they would actually have to sign a form. So anything we take off their paycheck, they would actually have to sign off on. And then United Way. So I'm just assuming that United Way is a charity. So the employees here would have agreed to have money deducted from their paycheck in order to make a charitable contribution. So there's other types of source deductions as well. There could be union dues, basically anything. So once I do that, I'm going to try and figure out how to balance out my journal entry. So the quickest way to do that is just to add up both sides. So I'm adding up this side and then I'm adding up this side. So this side is 65950 and this side is 756.7. So if I just subtract everything on the credit side from the debit side, that's going to balance out my journal entry. So that gives me 50193.30. And that's referred to as net pay. And this is the amount that I owe the employees. So this is gross pay. And then this is net pay. So after we deduct the amounts for the net pay, the next step that we have to do is record the employer's payroll deductions. So the employer not only has to remit EI and CPP for the employees' half, they also have to do it for their half. So they have to remit the equal amount of CPP plus 1.4 times EI. So that's just the rules. So I'm going to have to then record EI expense. So this is the employer's portion. And I said we're going to do the EI, what the employee paid, and we have to pay 1.4 times that. So that's going to be 1532.68. So I'll just remind you again what that was. That's 1094.77 times 1.4. And we have to match the employee's CPP contribution. So that's the 3097.93. So that adds on an extra amount of 4630.61 that we have to pay. So you can put this into one tax account. In this textbook, they actually create separate payable accounts for each of them. So I'm just going to do that. Now the third journal entry is to make the remittance for the taxes on April 15th. So we actually have 15 days from the end of our pay period in order to pay the tax to Canada Revenue Agency every month. So in this question, we're paying monthly. So if my payroll was at the end of March, then I would have until April 15th to pay Canada Revenue Agency the taxes that I owe. So we're going to go ahead and do that journal entry. So on April 15th, this is the journal entry that we're going to make. I'm going to debit EI payable. So when I debit the payable account, I'm actually now bringing the account down to 0. So I have EI from here, and then I also have EI from here. So it's both the employees and the employer's portion that I'm remitting. So maybe I'll highlight these ones in a different color for you, just so you can see what I added together. So it was this EI payable and this EI payable. So the employees and the employer's portion. I'm also going to do that with the CPP payable account. I'm going to clear them out. So it's going to be the employee's portion plus the employee's portion. And I just noticed I made a little mistake here. This should be called CPP expense. So let's do that. Change that. Perfect. So again, I'll highlight those in yellow. So the 3097.93 and this 3097.93 and the taxes. So this is the tax payable. So by debiting the payable account, I'm clearing that out to 0. And then when I credit cash, I can either do a checkup and mail it to Canada Revenue Agency, or you can bring it to the bank, or you can actually just do it online, which is what a lot of companies do now, is they'll just file their taxes online. So the amount that I actually had to pay to Canada Revenue Agency for this payroll was 17,918.31. So when we're ready to pay the employees. So you can either just do individual checks up for them, or you can have it direct deposit into their bank account. Then we would reverse this salaries payable out and then take the money out of our bank. So we would credit cash. And then the same thing when we pay the insurance provider and also the United Way, we would reverse these two payable accounts, and I should probably call this payable. And bring those to zero and then just credit cash.